Hello everyone, today we are going to talk about how you pay your taxes and your homeowner's insurance in your monthly payment after you bought a house. So here we go. So something that a lot of people may not know when they go to buy a house is that your payment, typically, if you're a first-time home buyer for sure, your payment is going to include more things than just your mortgage payment itself. It's not just going to be the principal and interest going toward your mortgage. What happens on most transactions, if you're a first-time home buyer, is that you're going to be paying for your taxes and your insurance, along with possibly mortgage insurance. But most of the time when you have impounds on your account, and I'll get into what that means in a second, you're going to be paying into your taxes and your homeowner's insurance with your mortgage payment every month. Now, why is this? And this happens because, well, for two good reasons, actually. If you don't have insurance on your home, that's a thing that automatically triggers your mortgage going into default, or can not so much default like you didn't make a payment, but the lender can say, hey, your house is not insured or your policy isn't current. We're going to start the proceedings to take your house, because if something happens to it, it's just gone and there's nothing protecting the lender from all the money they just lent you to buy that house. Then at that point, they don't even care about you and where you live. It's mostly protecting the asset itself. So that's what happens with the insurance, and why insurance is so important on your home. Now, when your mortgage is paid off, this is not common knowledge, when your mortgage is paid off, you don't have to have homeowner's insurance. Now, is that wise? I would say no, that isn't wise, because if something happens to your house, what are you gonna do? But it's an option at that point, but as long as there's a mortgage on it, you have to have insurance on it. So that's one of the reasons why it's really important. Taxes. Now, why are you paying your taxes each month? They're not due every month, but a portion of your payment is going into your tax escrow account. It's being impounded so that when taxes are due, they're going to be paid by your servicer. They're collecting that money to the side. Taxes come due, they pay it. Awesome. Why do they do that? Because taxes can supersede the mortgage. If you don't pay taxes on your house, even though you're paying the mortgage payment, if you don't pay the taxes, I believe it's after a few years, within 3 to 5 years, might even be less now to think about it, the state can take your house for unpaid taxes. They will basically take ownership of your home. And that's something that, of course, the lender doesn't want happening, because they want to get paid on all the money they lent you. So that's the reason why it's an impounded thing that goes into your monthly payment. So when we talk about your monthly payment, we talk about usually PITI, principal, interest, taxes, and insurance. If you have an association, like a homeowners association, that is usually something we talk about, and it's going to be a part of your payment, but doesn't actually go to your servicer. It's just something we have to take into account because it's something you're obligated to pay each month. So just something to be aware of. That's when we call it PITIA. But PITI is what you're normally talking about when you're talking about that full payment. So if you go online right now and you look at a home that you found and you see the purchase price and you say, I put 10% down, here's the rate they give you, and this is the payment, sometimes that payment is just the principal and interest. A lot of people see that and they go, wow, this is actually pretty affordable. I could do that. That's close to what rent is right now, or maybe it's less. It looks great, but it usually doesn't have, unless it explicitly says it does, and it's usually estimating some figures, the taxes and the insurance that you have to pay each month. So what happens when you make this payment? So your property taxes are only due twice a year, so that portion goes to the escrow account. We talked about that. Your homeowner's insurance is only due once a year. So basically, you're paying 1/12 of your premium in every payment, so that when it's due, your servicer pays the whole premium for the next year. So you're basically setting money aside ahead of time for when it's due. Now, this can trip people up as well, because half of your closing costs are called prepaid items. They're money, that's your money, that's going to be set aside to establish that escrow account, so that when you start off in your home, there's already enough money in there so that when the taxes are due, they'll get paid. When your homeowner's insurance comes due, it'll get paid. I mean, usually the whole premium is paid during the transaction, but usually they want a couple extra months of impounds in there. They want a cushion, and every servicer is different. They require a small difference in cushion. So you figure almost half of your closing costs are actually your money being put aside for your benefit to pay those things in the future. So I wanted to kind of go over the basics as to what is all in that monthly payment. If you have mortgage insurance, your servicer's collecting it. You don't have anything to do with that. They're the one that's actually going to pay that off to, whoever holds that policy. But Taxes and insurance, that's how they work. And that's what's going to be a part of your payment. And you got to be aware of that when you're shopping or looking at numbers, because properties can be different even from street to street if the tax rate is higher. So that can change the difference. When you get pre-approved and you have an idea, wherever you're looking, those figures will change, because it's going to be, your taxes are going to be specific to the purchase price and that property. It's very, very specific to it. And if like you're in a flood zone or something, you need extra insurance, whatever, that's going to change how much your insurance is. Or if you're in a fire zone. In California, that's a big thing. There's fire zones everywhere. Or too much brush or anything like that can cause your insurance premium to be higher. So things to be aware of. Now, before I get to the next two things that are really important that can happen right after a transaction that you need to be aware of, and I've seen it happen a few times. If you like this content, go ahead and hit a like on here, take a quick pause, subscribe to the channel if you haven't. I'm a newer YouTuber, I haven't been doing this for very long. I'm looking just to grow the channel. The more people subscribe and start watching the content, the more chance of this information getting out there and more people being able to see it and learn from it, and it'll hopefully be something that helps other people. So that's just my ask for this time. But yes, if you haven't already, please subscribe. So here's two things that can happen, and I have seen this happen a few times, not a lot, but a few times, and you have to be aware of it. Now, after you've closed on your purchase, you bought the house, yay, it's great. You most likely, not always, but most likely, you're going to get a bill from the tax assessor for something called supplemental taxes. And it's usually going to be, between like $200 and $400, sometimes $600, and there's going to be two of them. But you're going to get a bill and you're going to say, hey, I thought we took care of taxes when I bought the house. And you did take care of those taxes, but supplemental taxes are these weird numbers that kind of fall in between what the seller paid during the year for the property taxes and what you're obligated to pay moving forward. Sometimes there's a gap in who pays what and when it got paid, because the county tax assessor is always behind everything. They move slowly. They're not ahead of who did what and when and where, so it kind of catches up. So you might get that bill in the mail and it'll say on there, supplemental taxes. Just keep an eye on that, because you are responsible to pay that. You don't want those to go delinquent, because it's just like a regular tax bill. Going delinquent on something like that is not good. You start incurring penalties and fees and stuff. So if you get that, just be prepared. It's not something that was missed. It's now something you're obligated for. Now, I've had that happen on a few transactions. I think even when my cousin bought his house, same thing. He got a supplemental tax bill. The second thing, and this is a big one. I've had this happen, I think, having 3 transactions over the last maybe 4 years. If you get a really large escrow refund, so the escrow that you did your transaction through, depending on where you are, it might have been through a lawyer. If you get a really big refund that you weren't expecting, that your loan officer didn't tell you about, ask them about it real quick just to make sure. Call the escrow company or the lawyer's office, whoever you're dealing with, whoever you worked with, and ask them, why did I get such a big refund? I want to know what this is. And the reason is sometimes during what time of year you purchased, and if the seller paid the taxes for a certain part of the year or didn't, now the county doesn't have the correct record of what was paid and when. And what happens is your servicer is not completely linked up with the county either. The servicer is a big company usually that takes loan payments. So what they're going to do is they get this new loan, they just got it, they see it and they say, hey, there's a huge amount of money in this escrow account, way more than what's due for taxes right now or for what should be impounded. We're going to go ahead and refund that to the person. So what can happen, and what has happened on a few occasions, is that now you get this huge chunk of money and you go, yay, I got $4,000 or $5,000. I wasn't even expecting it. How awesome. No one told me this would happen. And then they get a tax bill for unpaid taxes. And what happened was that there was a disconnect, and it's usually a timing issue, that your taxes became due. They went to the servicer. The servicer said, we don't have that money in the account. We refunded it. It goes back to you. Hopefully you saved it, and now you have that to pay the tax bill. It's only happened a couple times, at least in the few times that it has, it wasn't a huge detriment because the person held on to that money. But if you got that money and spent it and now you have a huge tax bill due, it's not a good situation to be in. So things to be aware of after you've closed on your purchase and what can happen with taxes. So those are just some things that just things that can happen. Things to be aware of what actually goes into your full monthly payment when you're buying a house, and just the little ins and outs of how it works. They can trip some people up because those are figures that it can move a little bit depending on the property. They say, hey, you qualified me for this and my payment was going to be $1,300 a month. Hey, but this property is $1,500 a month. What's the deal? And I was like, well, the taxes are higher. You know, you can't foresee that because it's specific to the property. So anyway, if you like this kind of content, if you find any value in it, please like and subscribe. Comment down below if you have any questions, if you ever run into anything weird like this with your taxes. It's a weird thing. There's a lot of moving parts and it can throw some people off. So anyway, that's it from me, guys. Thank you for your time, and we'll catch you after Christmas. All right, bye.